professional thinking about your mortgage and thinking you got this big debt hanging over your head, I want you to stay tuned today and listen in because we're going to talk about a different perspective on it. So stay tuned. Buying a home is a significant milestone, and for most people, it involves taking on a mortgage. So this leads to a critical question. Is my mortgage really debt? On the surface, a mortgage seems like any other debt, but it really holds some unique properties that set it apart from car loans, credit cards, and other financial obligations. In this episode, we're going to dive deep into what makes a mortgage different, how it functions as an investment, and why it might not be fair to label it as just another debt. We're going to start with some basics, but I encourage you to stick around because there's some concepts here towards the end that you may not have thought about. What is a mortgage? At its core, a mortgage is a loan specifically used to purchase property. This can be a home, a piece of property, rental or commercial property, and you borrow some money from a lender. You're agreeing to pay it back over time, usually 15 years, 30 years, with interest. Interest rates may determine the price of the house you can afford, even with a mortgage. So what does that mean? Well, the higher the interest rates, right, then it increases your monthly payment. And your monthly payment is determined by basically what you can pay, call it your salary, your income, whatever. So if the mortgage rates are high, which we know some of what's going on right now, mortgage rates are high, you may be limited on the home that you can buy, or you may end up having to put down more money just to get a lower payment that you can afford on a monthly basis. So the property itself serves as collateral. And what that means is if you default, meaning you haven't made your payments, the lender can seize your home or property that the mortgage is on. But there's more to the story than that. Rent versus mortgage, the investment perspective. So one of my mentors has a saying that sticks in my head when we talk about mortgages all the time. And he says, it costs money to sleep indoors. So that's true, isn't it? Whether you're paying for a hotel, you're paying rent, or you're paying a mortgage, it costs money to sleep indoors. And I want you to think about this. When you pay to stay in a hotel, that money is spent. We call it expense or we call it a cost, right? So the same thing is true for paying rent, right? You spend, you expense the money, and while you have a roof over your head, you don't have any ownership. And while it may be convenient and flexible, you have no ownership, or the industry term is equity, meaning money that's building for you on the inside. So every rent payment is money that you're never going to see again. It's what we call a sunk cost, means the money went in, it's never coming out, and there's no financial return. So when you pay a mortgage, part of your payment goes towards paying the principal. So the actual loan amount, while the rest of it covers the interest. And over time, as you pay down the principal, you're building some equity, which is the portion of the property you own outright. So this equity grows as you continue to make payments, and it can grow as a property appreciates in value, or we say as a property goes up in value. Think about that. If you have a mortgage and you have a house, is your house worth more today if you sold it than it was 10 years ago when you bought it? My guess is probably yes. So if a hotel and rent is an expense and it costs money to sleep indoors, is your mortgage, which is really like rent with ownership, really debt? Rent is not a debt. So why do we look at mortgages as debt? The collateral on the loan is the property itself. Okay, in most cases, unless there's a huge drop in the housing market, our property is worth what we paid for it. Meaning, if you had to sell it, most likely you could get your money back out of it. Debt, the way we know it, doesn't work that way. You've got credit card debt, that is debt. You can't really get your money back out of it. Your car loan has car as collateral, but if you turn it back in, I promise you're not going to get all your money back because they're depreciating the car the minute you drop off the lot, right? So think of other types of debt and can you get your money back out of it? So for your home, when you sell it, you can not only get your money back out of it, the collateral on the loan is the property itself. In most cases, unless there's a huge drop in the housing market, our property is worth what we paid for it or more. Meaning, if you had to sell it, most likely you could get all your money back out of it. So debt, the way we know it, doesn't work that way. If you've got credit card debt, that debt, you really can't get your money back out of it. If you've got a car loan and you turn your car back in, you really can't get that money back out of it because guess what? The minute you drive off the parking lot, they're depreciating the value and it's not worth as much as it was when you first purchased it. So think of other types of debt. Can you get your money back out of it? So for your home, when you sell it, you can get your money back out. And especially in the last 10 years, you can get it out with a profit. So that sounds more like an investment than a debt, doesn't it? Remember, it costs money to sleep indoors. Is how you do it an expense or an investment? This is why I don't look at a mortgage as debt. I have to pay a mortgage to sleep indoors. For me, I would rather do it as an investment and get some return versus it just being an expense. So tax benefits of home ownership. So homeowners often enjoy tax deductions on mortgage interest and property taxes, reducing their overall tax burden. And while a lot of us are complaining because when we're in states like New York and California, they've really limited what we can write off, we still get that deduction. So renters don't receive these benefits, making homeownership financially advantageous beyond mere just equity building and the appreciation on the property. So keep in mind that if your home is paid off, you no longer have this tax deduction. You've killed that golden goose, so to speak. So is my mortgage really debt? It's not as simple as you may have thought. While a mortgage is a loan, it's unique in its potential to build equity and appreciate in value, offering financial growth opportunities that traditional debt can't. So let's keep going now because we're getting to my favorite part. Okay, so we're going to talk about building equity and appreciation. Each mortgage payment increases your ownership stake in the home. This is a stark contrast to rent, where payments don't contribute to ownership. They don't contribute to anything. It's just like staying in a hotel long term. So essentially, paying a mortgage is like putting money into a savings account that grows over time. But here's the dark side that nobody's telling you, and I really want you to think about this. We've been taught that we should pay off our house and be debt free. But we just talked about the fact that this isn't a debt that we look at like a regular debt. So I get it that we don't have to worry about a house payment later in life, but here's a couple questions that I have for you. And I'm going to give you an example of a young couple in their mid-30s that came to me and as a referral. So we talked about where they were in their lives, what they were doing for saving for the future, and both were working. One was a medical professional and one was an IT engineer. So good cash flow. They're making a good amount of money. They're maxing out their 401ks at work. They're paying off credit cards monthly and making extra payments on their mortgage. So I said, So I asked them, are you in your forever house? And they said, no. And I said, well, what would make you move? And they said, having kids. And I said, okay, so when's that going to happen? And they laughed. I mean, leave it to a financial professional and ask them when they're going to start having kids. And they said, well, 2 to 5 years. And I said, okay, well, since you're making extra payments on your mortgage, are you going to be able to sell your house for a higher price because you put more money into it? Very quiet, dead silent. He comes back and he goes, no. And I said, okay, so are you making interest on the extra money that you're paying on the mortgage? And he says, no. And I said, so then is that a good place to invest your money? And he says, no. And I said, well, if you get sick, you can't work, have some sort of emergency, and do you still have to pay your mortgage even though you made extra payments? And he said, yes. And I said, so what kind of deal is that? So let's think about that. No matter what happens, no matter how much money that you've put into it, if you get sick, you can't work, you lose your job, whatever, we've all had emergencies in our lives or known people that have had them, you still have to make those mortgage payments. So my point here is that having the money to pay off your mortgage is a great thing. And I highly encourage having those savings. But what if that money was actually working for you, making interest versus sinking it into that black hole called a mortgage, making no interest? So think about this. Even CDs at 5% are better than the 0% that you're making by putting that into this pretty inaccessible bank. And that's what it is. It's an inaccessible bank. So what is your home equity? So this is your home equity, right? Look at that. I can hand it to you through the computer. Your home equity is just like that. It's not really a thing. It's money sitting in a place that you have very little or no access to, okay? So the reality is that the increased value or equity in the home is not really yours until you sell the home. And then guess what? Most likely you need to buy another one. So there goes a good chunk of the money to do it all over again. I've got a lot of clients who are like, oh my gosh, my house is worth, whatever, zillions. And I'm like, that's great. So if you sell it, what are you going to buy? And guess what? There goes all of that money. But for the moment, it's locked up into the house until they sell it. So again, your equity, it's just like a rubber piece of cash that it's a number on paper, but it's not really cash in the bank. I'd rather have cash in the bank. So the moral of this story is that when you dump extra money into your mortgage or pay it off, you've just created another qualified plan. So what do I mean? Well, just like your 401k, you have to qualify to take the money out of it or have access to the money. That's qualified plan. And while you may have access through a home equity loan, it's never all of your money, and you have to qualify for that loan too. So if you can't work, if you don't have the income, you lose a job, you get sick, whatever it is, you typically can't even get access to your own equity. Doesn't seem like a good place to put your money or have a bank. So what do? Well, I have a mortgage payment by choice. and I pay what's required to pay. And then I use any additional money that I have to invest and make money. So I look at it that if I have the money in my left pocket, if I've got all the money to pay off my house in my left pocket, but that money is making money, whether it's 5%, 7%, 10%, whatever it is, then I have the access to the capital. And I've got the ability, if I ever wanted to pay it off, I would pay it off. But remember, as soon as I pay it off, all that money is there locked forever until I sell my house. I hope that makes sense. Your equity isn't really something until you sell your house. Now, do I imagine myself selling my house anytime in the near future? No. So if I'm not selling my house in the near future, I don't want to dump my money into this black hole. Okay. So access to capital, you could learn one thing from today. Access to capital is king. You want access to your money. Remember that. When we don't have access to capital, when we need it, that's when the negatives start piling up, right? When we don't have our money, that's when we have to use our credit card. We have an emergency medical bill, things like that. That's when we start really having problems, is because we didn't have access to the money. You may not realize it, but today you got a second opinion on mortgages from me. We've talked a lot today about having access to capital. It's your money. This is all part of getting your money working for you and accumulating efficiently for a hard-earned retirement. While it may be hard or you don't want to think about it, I want you to look at your retirement as a destination. It is a destination. It's a place that you want to go. A lot of people feel like retirement is so far out and they're not sure exactly what to do now. But then what happens is, if you don't start planning for it now, you're going to end up working a lot longer than you planned on, or you're going to have to reduce your lifestyle for the things that you actually wanted at that point in your life. So you could push this off, or we could actually hop on a call and have a conversation about creating a safe, optimized strategy so that you can retire when you want on the terms that you want. Do you want the 6-hour train trip with 10 stops, or do you want the express train that gets you there in an hour? You wouldn't plan a trip around the world the week before you left, so don't do that with your retirement. It's actually the longest vacation of your life. On average, retirement is 22 years. So how do you plan a vacation like that? So think of this as a second opinion, just like you do in the medical world. Click the link and let's talk about it. And we'll see you next week.